If you are trading volatility 75 index are still blowing up your account, then this strategy is for you. In this video, I will be showing you the beginner friendly strategy that I personally use. I'm going to break it down step by step so that you can apply it immediately. Make sure you watch the confirmation rule because this is where many beginners actually blow up their account. So without wasting much time, let's get started. So guys, before we dive in properly into this strategy, let me quickly show you some of the trade which I have taken so far using this particular strategy. And the first trade is somewhere around this region. You can see that on this particular trade, we had a very good risk to reward ratio of about 1:6, right? So this is one of the trade I've taken using this particular strategies. There are other areas where I took some trade as well, like this particular place. This one give me a risk to reward of 1:4.56. So and yes, I missed a trade here. Not a miss, is because the trade did not come to my POI, and as a disciplined trader I must not jump into any trade. And this is another one that actually smashed profit at a risk to reward of 1:3.89, almost 1:4 RR. So in this video I'm going to show you the proper way to identify these strategies and how you can also apply them. And I will also show you the confirmation rules, which is the reason why a lot of traders have ended up blowing up their account, because they do not understand this confirmation rule, or probably they neglect it and they see their account being wiped out just because of that little mistakes. Okay, now what does these strategies entail? In these strategies we are going to consider few things, which is number one, we're going to consider market trends. And when I mean market trend, we want to see the overall bias of what the market is doing. For instance, there are two types of market trend that we want to identify. We want to see that either a market is bullish or bearish, and from what we have learned from market structure, we say that when a market is bullish, it has to exhibit a character that is similar to what you're seeing on my screen, which is a series of higher highs and higher low, right? And when a market is bearish, we want to see the market creating what series of lower lows and lower high, just like what you can see from my screen here. Okay, so having identified this market trend, mind you, for you to have a proper direction of where the market is going, you must look at it from the higher time frame perspective. That means in order for you to have the original direction of the market, you must go to the higher time frame. And when I said higher time frame, I'm referring to either the 4-hour time frame or the 24-hour time frame. So you need to check these two time frames to actually determine your trend. Now that you have identified that the market is bullish, as in this case, the next thing you want to do to apply these strategies is you have to scale down to like 1 hour. Now, if you are a day trader, I will always advise that you identify this pattern on the 1 hour. But if you are a swing trader, you can always stick to the 4 hour to mark out your zone. So you identify a region where there is a sweep of a previous low, right? And then you identify a break of structure, which is what you're seeing right here. Now the market will always have that pullback. Okay, now there is a condition to this pullback. The mistake many traders are making, especially beginners, is they don't even know what a valid pullback looks like. Now for a pullback to be valid, or for a retracement to be valid, that retracement must be below the 50 Fibonacci level if the market is bullish. Okay, so since we are dealing with a bullish market, we need to check for either we need to check for the validity of our pullback, which is this particular push from here to this particular level. So you use your fib level to draw from this low right here to this high. Okay, now you can see that this is the 50% level and this is our retracement. You can see that the retracement is below this level. So suppose we have something like this, this would have been a wrong market, because this retracement is not a valid retracement. Now I'm also giving you some of the mistakes that a lot of traders are making, right? So you've identified our what valid retracement. The next thing we want to pick out is what our area of value. And when I say area of value, you don't just want to trade from any point in the market. You need a specific area where you actually want to make your trade execution, and that particular area is what we call area of value, right? So, and this area of value can either be a support level, it can be an order block, or a demand level, since we are dealing with what, a bullish market. So you come to this particular region. This is the region where you want to look out for this zone. You look out for a demand candle here, and you extend it out. Now, once you have been able to identify a valid area of value, the next thing is to be patient enough for price to give this retracement. Now, this particular retracement here creates a liquidity, and this liquidity needs to be taken. Remember, when we are doing this analysis, we said that there was a sweep of a previous low. This was a previous low. Price took it out and gave us a break of structure in the opposite direction. Now, price has created another liquidity that must be taken. So you have to be patient until price give this retracement. That means even if price do something like this and start going up, you are not interested. You want to be patient enough until price tapped into your POI. Now, when price tapped into your POI, that is when you can now start thinking about what, your confirmation rules. Before we dive into confirmation rules, let me quickly show you how you can mark out a bearish market, and also show you how you can identify some of this marking on the chart. I can even use some of the trade I've taken to give this explanation to make things very easy for you. Now, when you come to the bearish market, remember what I said, that the first rule is identify the overall trend of the market. Is this particular market bullish, or is the market bearish? Now, since we are dealing with a bearish market, we want to also see that there was a sweep of a previous high. It is very important. Now we are dealing with a bearish market. We want to identify a sweep of a previous high. Initially, we are dealing with what, a bullish market, and we start by identifying a sweep of what, a previous low. So now that we have seen a sweep of a previous high, as in the case of a bearish market, the next thing is always a break of structure. Okay, price gave us a break of structure here, and then we have this retracement. Okay, now this retracement is also creating a liquidity for us, right, that needs to be taken out, and then we have our second break. Now, whenever you have two break of structure, either if you are dealing with a bearish market or bullish market, you have an A plus setup or a high probability setup. In this case, we also have two break of structure here. Here is the second one. Okay, so when you have two break of structure, you have a valid or a high probability trade setup, and the next thing is to identify your area of value, which we are going to extend out. And the next thing is we need to be patient enough until price give us a retracement back to this zone. Okay, so the moment price gets in here, the next thing you want to pay attention to is confirmation rule. And like I told you, the mistake a lot of traders are making, or why a lot of persons have blown up their account, is because they do not understand these confirmation rules, which I'm going to take my time to explain to you in no time. But before we dive into that, let's quickly look at how we can identify some of these things which I've explained using schematic. Okay, now when you look at this particular region on the charts, when you look at this particular level here, you will notice that price actually took out this high. Okay, price took out this high, right, and it gave us a break of structure. Okay, now when price gave us this break of structure, we had this retracement. Okay, and this retracement is what is creating a liquidity, and that's the reason why I've extended it out. In this case, we are dealing with a bearish market. So I am doing this thing with the understanding that the overall trend of the market as at this particular period of time is bearish, right? Remember, that is the first thing. You must identify the trend of the market. So the market is bearish as at this particular period of time. So I scale down to the 1 hour to actually do these markings, right? And I've identified this particular point as what? My liquidity. Remember what I told you, that for you to have a valid retracement, it has to be below the 50% Fibonacci level if you are looking out for a buy, and it has to be above the 50% Fibonacci level if you are looking out for a sell. Now let's use this Fib tool to actually check if this is a valid pullback for us. Okay, so I will extend it to this particular point right here, and the next thing is to check, is it above? Yes, this is the 50% and this is the line. You can see that the line we marked out is actually above the 50% Fibonacci level, and that tells us that we have a high probability setup. And like I told you, that you need to mark out your area of value. Your area of value can either be a support or resistance level. In this case, since we are dealing with a selling market, then we'll be talking about resistance, or it can also be a supply candle, right, or a bearish order block. Okay, so this is the candle that I have marked out as my area of value. So the next thing is to exercise patience until price gets to this particular box. It took some time, but eventually what happened, price get in here, gave us that sweet confirmation, and it sold all the way to our take profit level. So that is one region where these things are happening. Here is another point. Here is another point, but then we do not have market reaction on that particular region. So, but anytime price get in there, we want to be patient enough to see that we wait for our trade setup. And one of those places is number one, you will always see that price will give you that sweep of a previous high, which is what we have here, right? And then price give us what? A break of structure. So you can consider this. This is where the break of structure happens. Okay, and we have this retracement. Okay, and after this retracement, price give another break of structure. And remember what I told you, that the moment you have two break of structure, you have a high probability setup, and this particular retracement is what we can consider to be what? Our liquidity. Remember, for your retracement to be valid, since we are looking at for a sell opportunity, it has to be below, sorry, above the 50% Fibonacci level, and you can see that it is above the 50% Fibonacci level, making this retracement a valid retracement. So the next thing we are looking out for is what? To wait for price to come to this particular supply candle, and we will have our trade setup. And trust me, this is a high probability setup that you can wait for. Okay, so that is that about how you can apply them. Now let's talk about the confirmation rules, which I've promised to explain to you guys. Now when we talk about confirmation rule, the most important ingredient is candlestick anatomy. Before now, I've made a video breaking down how you can read and interpret candlesticks. So if you have not watched those videos, kindly make sure you visit the previous video to do justice to that. Now for your confirmation candle, there are specific candle you want to pay attention to, and number one on my list is the likes of rejection candles. Now when we talk about rejection candle can be a doji, it can be an inverted hammer, and it can be a hammer. Now an inverted hammer is the type of candle you are looking out for when you want to look out for a sell position. For instance, if I'm looking out for a sell position using this schematic, once price gets into this box, I'm not just going to rush in to start making trade execution, right? I need to wait properly for price to form that particular candle which I'm looking out for. And I've told you that you need to look out for what? If you're looking out for a sell, watch out for inverted hammer or shooting star. Secondly, watch out for evening star candle. Evening star candle is a three candlestick pattern that tells you that sellers are now in control of the market. So these are the these are the few candles that you want to pay attention to when you are looking out for a sell. If you are looking out for a buy, you want to watch out for what? Doji, likes of morning star, and also a hammer candle. Okay, so these are the candles that you want to pay attention to. So I believe you understood everything I have said so far, and you need to avoid some of the mistakes that traders are making. Now, what are these mistakes? The mistake they are making is they don't wait for these candles, which I am explaining to you right now. You need to wait for this candle to be formed on your POI. Now, let me show you some of this candle which I am talking about. Remember, I mentioned in evening star. Evening star is a three candlestick pattern, right? Now this is an example of an evening star. The first candle is always, I'm going to mark it out here. Okay, if you look inside this box, the first candle here is actually a bullish candle, and the second candle is a bullish candle but a doji, right? So, and the next candle is a bearish candle, and you can see the the length of this particular candle, right? So these three candlestick pattern are what we collectively refer to as what? Evening star. So the moment you see this particular candle, you can always wait for this retracement. Price will always tend to make the retracement, and you make your entry from the 50% of this candle. So that means your entry is supposed to be around here. Your entry is supposed to be around here. So this is how you can apply this confirmation. Now let's check the other trade entry that I made, and let's see if we had confirmation on those ones as well. Okay, yeah, now let's look at this particular point. Look at this part. Remember what I talked to you about rejection candle, and I talked about shooting star or inverted hammer. Now do you see how beautiful this candle looks? Look at how beautiful this candle is. This is a rejection, telling you that the sellers have rejected the effect of the buyer and they are taking over the market. So the moment you see this candle, you can be patient enough to wait for the next candle. Now the next candle will confirm to you that they have taken over the market. So once you have seen this candle, you are free to make your trade execution the moment price gets into your POI. Now the summary of what I'm saying in this video is to apply this strategy. Number one, you must identify the trend of the market. Secondly, you must be able to identify the pattern, and the pattern is nothing but something that looks like the schematic which I have shown you here. So once you have been able to identify the pattern, the next thing is to wait for your candlestick confirmation. Okay, so if you can wait for your candlestick confirmation, you must have solved at least, 50% of your problem, right? So you identify the pattern like this or like this. This is the pattern you want to see for a sell. This is the pattern you want to see for a buy. Then the next thing, you wait for your confirmation. Now there is no trade setup that does not have a risk management system, and this is where a lot of traders get it wrong. So if you are not managing your risks, or if you're not applying proper risk management, you will still not succeed using this. So what are the risk management rules that you need to put in place trading these strategies? Number one, you must not use a very high lot size. Your lot size needs to be moderate so that you can protect your account. Secondly, you should always use take profit, and like I said, always target 1:3 risk to reward ratio. Then the last but not the least, always use stop loss. Do not trade without stop loss. Anytime you place a trade without using stop loss, you are indirectly saying that you are putting the whole of your account at risk, which does not make sense. I know a lot of persons will have other theory that will tell you, if you put your stop loss, the market can take it and start. There is no such thing and as anybody monitoring your stop loss. Nobody is monitoring your stop loss. That thing is just a propaganda. So make sure you always use your stop loss to protect your account. And if you find this video helpful, kindly make sure you hit the like button and subscribe to this channel so that others can also benefit from it. So this is where we'll be stopping. Ensure you watch my next video where I'll be talking about the risk management system that is applicable to all synthetic indices traders. So peace out guys, and see you in our next video on Skid Case.